Picture this. It's February 2036. You're 10 years older, maybe a little gray. You've worked hard. You skipped vacations. Every single month, rain or shine, you put $1,000 into the stock market because that's what the experts told you to do. So you open your brokerage app expecting to see a fortune, expecting compound interest to have done its magic. But the number staring back at you? Barely higher than what you put in. 10 years of your life, gone. This isn't a horror story. This is exactly what happened to millions of people between 2000 and 2010. The S&P 500, the safe index everyone tells you to buy, returned just 9% over that entire decade. Your portfolio got cut in half in 2002, recovered, then got cut in half again in 2008. Right now, in 2026, with markets at all-time highs and AI hype at a fever pitch, we could be staring down another lost decade. So today, we stop gambling. Today, we build what I call the Fortress Portfolio. 5 unbreakable pillars designed so that when the market crashes, you get paid, and when it booms, you get rich. Stay with me because Pillar 3 is the one most investors completely ignore, and it might be the most important one of all. Before we lay the first stone, you need the right mindset. Wealth isn't about making one brilliant move. It's about being consistent forever. The protocol is simple. ABB. Always be buying. Most people try to time the market. They wait for the perfect dip. They wait for the election results. They wait for the Fed to move. And while they're waiting, the market moves without them. The Fortress runs on automation. Every 1st and 15th of the month, money moves, period. Whether the market is up 20% or down 30%, the system doesn't flinch. Here's the mindset shift that changes everything. A market crash isn't a disaster. It's a blue light special on your future freedom. It's a 20% off sale on wealth. When prices drop, you shouldn't be scared. You should be drooling because you're buying more shares for the same money. Lock that in. Now let's build. Pillar 1, the bedrock. 40 to 50% of your portfolio. This is the foundation, the money you absolutely cannot afford to gamble with. We're talking about broad market ETFs, and here's why they're so powerful. If you buy one stock, you're betting on one CEO. One bad quarter, one scandal, and you could be wiped out. But if you own the total market, you own capitalism itself. Sears went to zero, but if you own the market, you just deleted Sears and added Amazon. The system self-corrects. You have 3 solid options here. Option 1, VTI, Vanguard Total Stock Market. This is the king of diversification. Every single publicly traded company in the U.S., from Apple and Nvidia down to the small biotech startup in Boston trying to cure cancer. The expense ratio is just 0.03%. That's $3 a year on every $10,000 invested, essentially free. Option 2, VOO, Vanguard S&P 500. This one says, I only want the 500 biggest, strongest companies in America. Historically, it has slightly outperformed VTI because the big tech giants have grown so fast. Same low expense ratio, 0.03%. If you want a similar option with an even lower share price, look at SPLG. I covered it in a previous video. Option 3, VT, Vanguard Total World. This is for the true global diversifier. What if the U.S. stops being the world's dominant economy? VT owns over 9,000 companies across every continent, U.S., Europe, Asia, emerging markets. The expense ratio is slightly higher at 0.07%, but you're guaranteed to own the winner no matter where it comes from. My verdict, if you're in the U.S., go VTI or VOO for the tax advantages. If you're outside the U.S., VT is likely your best bet. Pick one, just one, and automate your contributions.
Pillar 2, cash flow, 20% of your portfolio. Here's a problem most investors don't think about until it's too late. What happens if you need to retire in 2030, but the market is down 35%? You're forced to sell your shares at a loss. You're eating your own seed corn. The Fortress doesn't have that problem. We use dividend ETFs to create an internal cash flow engine, money that comes to you whether the market goes up or down. Option 1. SCHD, Schwab US Dividend Equity. This is the fan favorite, and for good reason. SCHD acts like a bouncer at a club. To get in, a company must have 10 consecutive years of paying dividends, strong cash flows, and a clean balance sheet. It currently yields around 3–4%, with a tiny 0.06% expense ratio. In a lost decade where stock prices go nowhere, SCHD is still paying you rent every 3 months. Option 2. VIG, Vanguard Dividend Appreciation. This one is for investors who want growth more than income. VIG focuses on companies that have raised their dividend for at least 10 years straight, the aristocrats. Think Microsoft, Visa, United Health. The yield is lower, around 1.8%, but the price appreciation tends to be stronger. Expense ratio, 0.04%. Option 3. DGRO, iShares Core Dividend Growth. Think of this as the Goldilocks option. Broader than SCHD, with over 400 holdings, it focuses on dividend sustainability and growth. Expense ratio, 0.08%. My verdict, put 20% here. Reinvest the dividends while you're working. Live off them when you retire. Pillar 3, the Shield, 5–10% of your portfolio. All right, let me be straight with you. Gold is technically a pet rock. It doesn't produce anything, it doesn't innovate, it just sits there. So why do billionaires hold it? Because gold is fire insurance for your financial house. Governments print money, that's what they do. In just the last 4 years, trillions of new dollars were created. When the supply of dollars goes up, the value of your existing savings goes down. That's inflation, and it's always happening in the background. Gold is the only major asset that cannot be printed, and when the world gets scared, gold goes up. In 2008, when stocks crashed 37%, gold increased in value. That's the shield doing its job. 3 ways to own it. Option 1. GLD, SPDR Gold Shares, the biggest and most liquid gold ETF. Easy to trade, but the expense ratio is 0.40%, which is high for a long-term hold. Option 2. IAU, iShares Gold Trust, does the exact same thing as GLD, but costs only 0.25%. Over 20 years, that difference compounds into thousands of dollars. Smarter choice for most investors. Option 3. SGOL, Aberdeen Physical Gold. This is my personal favorite, and yes, I hold this myself. The gold is physically stored in vaults in Switzerland and London, and the expense ratio is just 0.17%, the lowest of the 3. My verdict? 5–10% here. You hope you never need it, but when a financial hurricane hits, you'll be one of the only people smiling.
Pillar 4, the escape hatch, 10–15% of your portfolio. I love the U.S. market, but home country bias is a silent killer of portfolios. For the last 15 years, America has been the only game in town. But remember 1989 when Japan was the dominant economy? Remember the early 2000s when emerging markets crushed the S&P 500? History moves in cycles, and right now, U.S. stocks are expensive. The S&P 500 trades at a price-to-earnings ratio around 25. International markets closer to 14. That's nearly a 40% discount. Option 1, VXUS, Vanguard Total International Stock. This is your everything but America weapon. Over 8,500 companies outside the U.S., TSMC in Taiwan, Toyota in Japan, Nestle in Switzerland, all of them for 0.07%. Option 2, VEA, Vanguard Developed Markets. If geopolitical risk makes you nervous, you don't want exposure to China, you don't trust certain governments, VEA is your play. It sticks to stable first world economies, the UK, Japan, Canada, France, Germany. Developed international stocks also tend to pay higher dividend yields than U.S. tech. Expense ratio, 0.05%. Option 3, VWO, Vanguard Emerging Markets. This is rocket fuel for the aggressive investor. The U.S. population is aging. Europe is aging. But look at India, Southeast Asia. These are young, growing populations, people buying homes, starting businesses, driving economic expansion. If India becomes a global superpower in the 2030s, VWO captures that wave. Yes, it's volatile, but the upside can be enormous. Expense ratio, 0.08%. My verdict, 10–15% here. If the U.S. keeps dominating, you're fine. This is a small allocation. But if the global cycle flips, and it always eventually does, this pillar saves your decade. Pillar 5, the rocket, 10% of your portfolio. Now we want to get rich. The first 4 pillars protect you. This one is where the wealth acceleration happens. We're betting on the silicon age. Option 1, SMH, VanEck Semiconductor ETF. Pure play. The biggest chip makers in the world,
led by NVIDIA, the king of AI, plus TSMC and others. If AI really does transform the global economy, SMH could be extraordinary. But I need to be honest, this ETF is violent. It can drop 40–50% in a single bad year. You need a stomach of steel. If you panic sell during a crash, you lose. Expense ratio, 0.35%. Option 2, SOXX, iShares Semiconductor ETF. SMH's heavyweight rival, with a key difference. SOXX leans more heavily into U.S.-listed companies, Broadcom, AMD, Texas Instruments. It's slightly more diversified across chip types, AI, industrial, automotive, memory. Same thesis, different flavor of risk. Expense ratio, 0.35%. Option 3, VQQM, Invesco Nasdaq 100 ETF. Maybe you think the chip market is overheated. That's a fair argument. QQQM gives you the top 100 non-financial companies on the Nasdaq. You still get NVIDIA and Broadcom, but you also get Apple, Microsoft, Amazon, and Google. If the AI chip bubble bursts, Amazon is still shipping packages. Google is still selling ads. Microsoft is still running every office in America. QQQM wraps explosive tech growth in a layer of safety, and it's the cheapest option here at just 0.15%. My verdict, this 10% slice is the penthouse. Treat it like dynamite. Don't put your rent money here. But if AI really is the next industrial revolution, this allocation alone could let you retire 5 to 10 years early.
Let's bring the whole fortress together. Pillar 1, Foundation, 50%. VTI, VOO, or VT, the bedrock of American or global capitalism. Pillar 2, Cash Flow, 20%. SCHD, VIG, or DGRO, your dividend engine. Pillar 3, Shield, 10%. SGOL, IAU, or GLD, your inflation and crisis insurance. Pillar 4, Escape Hatch, 10–15%. VUSS, VEA, or VWL, your global insurance policy. Pillar 5, Rocket, 10%. SMH, SOXX, or QQQM, your bet on the future. Most people watching this are missing Pillars 3 and 4. They're 100% in U.S. stocks with zero protection, one bad decade away from a financial disaster. Don't be the person staring at a flat line in 2036. Build the fortress, automate the buying, then go live your life. Now tell me, which of these 5 pillars is currently missing from your portfolio? Drop it in the comments below. And if this gave you value, hit like and subscribe. It genuinely helps this channel grow. And I've got a video coming next that I think will genuinely change how you think about retirement. You don't want to miss it.